the mechanism. A complete journey through every level of wealth. You have $4,200 sitting in a savings account. It just sits there. Your bank is using your money to fund loans worth hundreds of millions of dollars. You will never know. Every 2 weeks, your paycheck arrives. You spend most of it. You save a little. You have heard the term compound interest before. Someone mentioned it once. You nodded. You did not understand what you were nodding at. Level 1. The Depositor. You open a high-yield savings account. 4.5% APY. You feel intelligent doing it. You set an automatic transfer of $200 every single month. It runs without you. At the end of the year, your account has earned exactly $89 in interest. You stare at that number? $89. It does not feel like enough. You are right. It is not enough. But this was never about $89. It is about the mechanism you just switched on. The machine is already running. You do not fully understand yet what it is building. You are not an investor. You are a depositor. But the distance between them is smaller than you think, and it is not measured in dollars. Level 2. The investor, you open a brokerage account. Index fund. $500. You press confirm. The broad U.S. stock market has returned approximately 10.5% annually over the last 80 years. You know this now. You turn on automatic dividend reinvestment. Every payout immediately purchases more shares. Month 1. $500 invested. $1.40 in gains. Month 12. $6,300 invested. $180 in gains. The market drops 6% in a single week. Your portfolio loses $300 overnight. Your hand moves toward the sell button. You stop. You put the phone face down. You breathe. You hold. E-type. $500 monthly. 40 years. 10% into a calculator. The number that returns is $3 million. Something shifts. You stop seeing money as something to spend and start seeing it as something that works. Every dollar you invest is a dollar that begins replicating itself quietly every single year, without rest, without asking, without requiring you to watch it. It just compounds. You are an investor now. Level 3. The Optimizer. You have $47,000 in index funds. You track your net worth every Sunday evening. You max your Roth IRA $7,000 per year, growing permanently tax-free. You contribute exactly enough to your employer retirement account to capture the full match. Not a dollar less. Not a dollar more than necessary to claim what is already yours. You read that a 1% expense ratio on a $500,000 portfolio costs approximately $360,000 in loss compounding over a career. You switch to the lowest cost index fund available. You never look back. 80% equities, 15% bonds, 5% international. You rebalance quarterly. No exceptions. A friend asks how to invest. You give the boring answer. Automate. Diversify. Do not touch it. They want to hear about something exciting. You tried exciting. You know exactly what it cost you. The insight is not a new investment. The insight is time. Compounding does not scale linearly. It accelerates. The first $100,000 takes roughly 8 years. The next takes 4. The one after that takes 2.5. At some point, your portfolio earns more in a quarter than your salary does in a full year. Nobody applauds. There is no signal. Building real wealth is invisible, and it is almost entirely discipline. Level 4. The Wealth Builder. Your net worth crosses $400,000. You do not celebrate. You open a spreadsheet and recalculate. The capital is accumulating. Your job is not to interfere with what you already built. A rate hike. Cycle drops your portfolio by 19%. You lose $76,000 on paper in a matter of months. You add $600 more that month. You buy into the decline. You tell nobody. You just do it. You build a 12-month emergency fund. Insurance airtight. Estate documents signed. Beneficiaries listed correctly on every account. You move beyond simple index funds. Municipal bonds for tax efficiency. Real estate investment trusts for yield and real asset exposure. You stop thinking in annual returns and start thinking in decades. People around you begin calling you lucky. You do not argue. You know exactly what it actually took. It was not luck. It was correct decisions made consistently over time, with no audience and no applause. The machine is running faster now. You can feel it. It does not need your attention to grow. It never really did. Level 5. The capital allocator, the next level, does not open with effort. It opens with a threshold. Your net worth passes $1.2 million. The system changes. New doors open quietly, without announcement. You are now an accredited investor under federal securities regulations, the designation that determines what investment instruments you are legally permitted to access. The private market appears for the first time in your investing life. A private equity co-investment arrives with a $50,000 minimum, a 5-year lockup, and projected returns significantly above public market benchmarks. You read every page of the offering documents. You understand the fee structure, the annual management fee, the carried interest above the return hurdle. Then you wire the funds. No hesitation. You enter a private credit fund. Senior secured loans at floating rates above 12%. Quarterly distributions. Illiquid. You understand the risk premium now. You are being paid for surrendering liquidity. That is the trade. To most. Financial content never explains this clearly. Above a certain threshold, the instruments change completely. A portfolio now generates returns through 4 simultaneous mechanisms: equity appreciation, dividend income, private credit distributions, and depreciation offsets from real asset ownership. You are not playing the same game as the person at level 2. The board is entirely different. It was not hidden from you before. It required capital to access capital. Now you have both. Level 6. The institutional player, the number is $6.4 million. You say it to yourself once, then stop saying it. You make contact with a family office wealth management firm. The minimum to be taken seriously is $5 million. They offer access to pre-IPO allocations, structured notes, and hedge fund strategies close to outside capital. You listen carefully. Your effective federal tax rate this year is 11%. That is not an accident, and it did not happen automatically. It required 6 weeks to structure correctly. Qualified Opportunity Zone investments. Charitable remainder, trust architecture. Stepped up cost basis planning. A Delaware holding structure for business income. All legal. All documented. All available to people who have enough capital to make the complexity work too. The wealthy do not simply have more money. They access a structurally different financial system, one with different instruments, different tax treatment, different legal frameworks, and different return profiles. That system existed before you reached it. You just did not have the entry requirement. Your children have education savings accounts seeded with $150,000 each at birth. At 7% over 18 years, each account approaches $510,000 before they finish school. This is not just building wealth. This is building wealth that builds wealth for people who do not yet exist. A sufficient scale. Compound interest stops being personal finance. It becomes structural power, transmitted across time. Level 7. The architect, you stopped checking the returns years ago. A 12-month emergency fund. Insurance airtight. Estate documents current. Beneficiaries listed correctly. A portfolio generating income through equity, private credit, real assets, and tax-advantaged structures simultaneously. You sit on 2 private company boards, not because you sought them, but because capital at this scale creates proximity to decision-making, whether you pursue it or not. You co-sponsor a venture fund? Your name is on the term sheet, not the press release. You have dinner with people who used to be entirely abstract to you, former officials, institutional investors, founding families. You did not arrange those meetings. Someone else did. That is the point. You did not seek power. Capital at this scale creates proximity to power as a structural byproduct. It is not personal. 2's mechanical. T. When the market drops 30%, you have liquidity, time, and structural insulation to treat the decline as a purchasing opportunity. People without those buffers sell at the bottom. That liquidity flows somewhere. Some of it reaches you. The system is not broken. This is what it was designed to do. You understand this now with a clarity that is no longer entirely comfortable. The people you call friends, you are no longer certain the word means exactly what it used to mean. You are a systemic participant now. Level 8. The institution. You are not an individual anymore. You are a trust structure, a holding company, a foundation, and a partnership. The foundation holds assets in the hundreds of millions. It earns 7% annually. It distributes 5%. It retains 2%. The foundation does not spend down. The retained percentage re-enters the principal every year. It grows permanently. The name on the building is not your name. It is the name of the trust. You prefer it that way now. Your great-grandchildren will be accredited investors at birth. The compounding began before they existed. They will sit on boards because the family name carries accumulated weight, decades of decisions, reinvested returns, and structured legal ownership compressed into a reputation that precedes them. Compound interest does not just grow money. At scale and time, it converts capital into legacy, into institutions, into a kind of privacy and freedom that most people cannot purchase because they did not understand early enough what they were building. The machine does not need you anymore. It has not needed you for a long time. You are the founder of something that will outlast you by generations, not because you planned it that way in the beginning, but because the mechanism, applied consistently and without interruption across enough time, eventually becomes self-sustaining. The beginning and the end are the same moment. Somewhere, a young person walks into the world for the first time this morning with a small amount of money and an idea that saving might matter. They open their first brokerage account. They set up a small automatic transfer. They feel intelligent doing it. They think this is about financial security, about retirement, about a better life. They do not know that the amount is not the point. Sure, the mechanism is the point. The automatic transfer, the reinvested dividend, the index fund held through the decline, the expense ratio avoided. The tax-advantaged account filled, none of these are individually the answer. They are each an activation of the same underlying force, the same force that builds a portfolio and the same force that builds a foundation. The same force that compounds $200 per month into $3 million and $3 million into something that has no ceiling. 2. The distance between that first $200 transfer and the institution at the end of the story is not measured in intelligence or luck or access. It is measured in time, consistency, and the compounding of correct decisions made without an audience. The machine, once switched on, does not need your attention to run. It never did. But you have to switch it on first. And then you have to leave it running when everything in your biology and your culture tells you to turn it off. That is the whole thing. Everything else is just the distance between the first deposit and the day you finally understand what you are building all along. The mechanism was always the point. It still is. The 7 principles running through every level, every stage in this story is driven by the same underlying forces. They do not change between levels. They just operate on a larger base. 1. Automation removes the decision. Every level in this story began with an automated transfer, money moving before the brain could negotiate. The monthly transfer to the high-yield savings account. The automatic dividend reinvestment in the index fund. The scheduled payroll deduction to the employer account. Each one was a decision made once that produced hundreds of correct behaviors automatico. Remove the decision from the monthly cycle and the behavior becomes structural. Structure is more durable than willpower. Always. 2. Time is the only input that cannot be purchased. Every compound growth calculation in this story is dependent on years, not dollars. Starting at 22 produces outcomes that starting at 32 cannot replicate, regardless of the contribution amount. A $200 per month investment at age 22, held for 40 years, produces a categorically different outcome than a $400 per month investment started at 32. The extra $200 per month does not compensate for the lost decade. Nothing compensates for the lost decade. Time is the one variable in the compounding formula that money cannot buy back. 3. Expense ratios are silent, compounding in reverse. A 1% annual fee on a large portfolio does not cost 1%. It costs the compounding on that 1% across every remaining year of the investment's life. A 30-year portfolio held in a fund charging 1% versus a fund charging 0.03% of a percent is the difference of hundreds of thousands of dollars, not from investment returns, from the fees that prevented those returns from compounding. Every dollar paid to expense ratios is a dollar that was permanently removed from the compounding engine before it could grow. Small percentages produce enormous numbers across decades. This works in both directions. 4. Tax efficiency is not optional above a certain threshold. At early levels, the difference between a Roth IRA and a taxable brokerage account is marginal. At later levels, the difference between an 11% effective tax rate and a 30% one is the entire margin between levels. Structure, legal entity design, account type selection, timing of recognizing income. Depreciation utilization. Charitable giving architecture is not a luxury available only to the already wealthy. It is available to anyone who accumulates enough capital to make the complexity worthwhile. The threshold is lower than most people assume. The cost of ignoring structure is permanent. The cost of implementing it is temporary. 5. The instruments change at each level. Public markets, index funds, bonds, REITs are accessible at the earliest levels. Private credit becomes accessible at the accredited investor threshold. Pre-IPO allocations, hedge fund strategies, and structured notes at higher levels. The return premiums associated with each level are partly a function of the instruments available at that level, instruments that compensate for illiquidity, complexity, and minimum investment requirements that serve as natural entry barriers. Capital unlocks access. Access unlocks instruments. Instruments unlock return profiles unavailable to public market investors. This progression is not hidden. It is mechanical. 6. Discipline during declines is where the long-term compounding gap is created. Every market decline in this story was an inflection point, a moment where the behavior of an investor with the right structure diverged from the behavior of an investor under pressure. Adding rather than selling during a 6% weekly decline. Buying during a 19% correction. Treating a 30% market drop as a purchasing opportunity when structural reserves exist. These behaviors, executed consistently across multiple cycles, produce compounding trajectories that diverge enormously from the trajectories of investors who sold at or near each bottom. The specific moment where long-term wealth gaps are created is not the bull market. It is the bear market. Discipline during the decline is the differentiating variable. 7. The machine eventually runs without you. This is not a metaphor. It is the mathematical endpoint of sustained compounding over sufficient time. A portfolio becomes a trust. A trust becomes a foundation. A foundation generates returns independently of any individual's decisions, indefinitely, without requiring the attention of anyone alive. The goal, properly understood, is not to reach a particular dollar figure. It is to build something that does not need you to keep running, a self-sustaining system that generates returns, compounds, principal, and distributes value forward in time without your active participation. The $200 automatic transfer at the beginning of this story and the foundation at the end are the same mechanism, operating on different scales. The distance between them is measured in time, consistency, and the accumulation of correct decisions made without an audience. The beginning and the end are the same moment somewhere. A young person walks into the world for the first time. This morning with a small amount of money and an idea that saving might matter. They open their first brokerage account. They set up a small automatic transfer. They feel intelligent doing it. They think this is about financial security, about retirement, about a better life. They do not know that the amount is not the point. The mechanism is the point. The automatic transfer, the reinvested dividend, the index fund held through the decline, the expense ratio avoided, the tax-advantaged account filled. None of these are individually the answer. They are each an activation of the same underlying force. The same force that compounds $200 per month into $3 million and $3 million into something that has no ceiling. The distance between that first $200 transfer and the institution at the end of this story is not measured in intelligence or luck or access. It is measured in time, consistency, and the compounding of correct decisions made without an audience. The machine, once switched on, does not need your attention to run. It never did. But you have to switch it on. And then you have to leave it running when everything in your biology and your culture tells you to turn it off. That is the whole thing. Everything else is the distance between the first deposit and the day you finally understand what you were building all along. The mechanism was always the point. It still is.